in the early 90s, a farmer from Elandskral in Limpopo named Gerrie Fourie wanted to process the peanuts he harvested into peanut butter and sell it on a large scale. However, the Oilseeds Board, then the regulatory body for that sector, had its own system. Farmers were first required to sell their harvest to the board and then buy it back at a marked price. To Gerrie, that didn't make sense. Now stuck with the ton of peanuts, he decided to sell them directly in large bags around Elandskral and Giyani. His customers were primarily black people in the area, and over time, through doing business with them, Gerrie began to understand their needs, and the biggest one amongst them was access to cash. He and his brother opened what appeared to be a peanut wholesale shop, but it was actually a front for a cash loan business. Now Gerrie didn't want others to copy their business model, and he also wanted to avoid attracting attention from criminals, so they kept a low profile. Now at the time, coming out the apartheid era, most black South Africans didn't have access to banking. The entire financial system favored white people or the privileged. Now most black people often didn't earn enough to qualify for loans, and their transaction sizes were considered too small to be profitable by big banks. For example, a loan under 6,000 came at a 3% interest rate cap, which was unattractive to big banks. Now as a result, the banks largely excluded poor and black communities. Meanwhile, white South Africans had stable jobs, home equity, pension funds, and access to credit from banks. Now with the majority of blacks unbanked and cash-strapped, township loan sharks stepped in to fill in the gaps. Gerrie and his brother quickly realized the scale of the problem and the potential gold mine it represented. Now in 1992, the Minister of Finance, Derek Keys, announced that loans under 6,000 rands with a term shorter than 36 months, lenders could charge any interest rate they wanted. The hope was that banks would begin serving people in need of small loans, but the banks showed little interest. For most people, that announcement went unnoticed, except for Gerrie and his brother. They began lending money by thousands, and the business grew faster than expected. Now to keep up with demand, they brought in a friend named Hendrik, who used to lease them farm equipment. Gerrie told him that for every 1,000 he lends out, he gets back 1.3. Hendrik saw the opportunity and he jumped in. Now Hendrik told his friend Louis about this opportunity. Now together, they went into business separate from Gerrie and his brother. Though business was booming, Gerrie and his bro continued operating under the cover of a peanut shop to avoid drawing too much attention and triggering a gold rush. Now Hendrik, on the other hand, he refined this process. He targeted salary workers, offering them short-term payday loans with 30% interest. They kept the borrower's cards and pins. They withdrew repayment amounts on payday and then returned the cards. Now payday loans exploded in popularity. They even began advertising in the Sowetan, reaching a wider audience and growing the business even further. In 1994, after South Africa achieved freedom, black South Africans had to be integrated into the economy. Almost overnight, government institutions were filled with black workers. Many white employees resigned. Some stayed and others received severance packages. At the time, many white South Africans found themselves sitting on a pile of cash, while a large number of newly employed black workers became economically active. This meant more salary individuals from the black communities and more potential for payday loan customers. But not all white people recognized this opportunity. But those who did told their friends and families. They pulled their money together and went into the payday loan business. With interest at 30% per month, it became a gold rush. Hendrik and Louis ended up franchising their business model. By the end of that year, they had opened around 374 branches, and you can guess who wasn't happy about that. Gerrie and his brother. They wanted to keep the business low-key. Now on paydays, loan sharks would be at ATMs early in the morning. The boerers with their 4x4s, armed with coffee in one hand and a pump action gun on the other. They withdrew repayments directly from their customers' accounts and take that cash back to the office to fund new loans. Now ATMs would sometimes run out of money. With so much money being made and desperate people being charged sky-high interest rates, the government had to step in. The then Finance Minister, Trevor Manuel, introduced new regulations to bring the industry under proper control and stop the exploitation. It didn't happen immediately, but everyone knew after that announcement that the gold rush was about to end very soon. Boland Bank is important to the Capitec story because Capitec was built using the blueprint that was created at Boland. But Boland collapsed before their plans could even materialize. Christo Wiese got the funding to buy out Rennie van Rooyen, the founder of PEP, from Boland Bank. He had served on the bank's board since 1985. In 1990, when Absa attempted a corporate takeover of Boland Bank, Christo blocked the move by purchasing majority shareholding. The Reserve Bank gave him the green light, and just like that, he ended up owning a bank. Coming from PEP and Shoprite, Christo understood that there was a lot of money to be made by serving poor black customers, an underserved market with massive potential. He wanted to reposition Boland to focus on that segment. Now, to do this, he needed a sharp, high-level operator to lead the transformation. His first choice was Whitey Basson, knowing Whitey's strength and track record. But at the time, Whitey was focused on growing the Checkers Group into the largest retailer in the country, so he declined. But there was another top-tier business mind Christo trusted, Michael LaRue. Now, LaRue had been a managing director at the distillers Rupert's company since the age of 30, running it successfully for 15 years. Initially, LaRue wasn't interested in banking. His passion was in the liquor business. But in 1995, when LaRue heard that McDonald's was coming to South Africa, he had planned to start a rival fast food chain, but he lacked the right team, and the plan didn't happen. Christo spent nearly 5 months convincing LaRue to lead Boland Bank. Eventually, LaRue agreed, but he knew it would be a tough job. Now, at the time, the bank was in poor shape and needed serious turnaround. LaRue started assembling a team of go-getters. The first person on his list was Rian Stayson, his former assistant and later head of distribution at Distillers. Now, Stayson was known for his skills in pricing and product strategy. Basically, these guys were what the media dubbed as the Stellenbosch Mafia. So the team that he was assembling were guys from Stellenbosch and guys that he had already worked with before. As the team dug into market research, they discovered a company called King Finance had already developed an effective model for lending to lower income customers without needing to take their bank cards or pins. Now, King Finance was part of a larger group listed on the JSE. So aside from competing with big banks, Boland also had to compete with nimble players already thriving in the informal credit space. The competition was tough. To build a strong foundation, LaRue brought in more trusted colleagues from his days at Distillers, people he believed in. Now, coming from the liquor industry, they approached banking differently from traditional institutions, bringing a fresh perspective and a strong commercial instincts. One of Boland Bank's early goals was to specialize in digital banking. They had a brilliant IT expert named Chris Oosthuizen, who had studied IT systems and ATM technology in Dallas, Texas. Oosthuizen revolutionized the bank systems. Instead of manually processing checks and balancing ledgers at the back office, he developed a digital system that automated those tasks years ahead of its time. He even built core IT infrastructure for a bank in Namibia. He was very good at his job. But eventually, things took a turn. Christo Wiese had leveraged most of his assets to finance his various ventures, and at some point he had bid more than he could chew. So to keep his broader business interest afloat, he had to sell the bank. Despite assembling a world-class team, building solid plans and implementing cutting-edge technology, Christo had to walk away, and Michael LaRue chose to leave the company as well. Yanni Mouton and Chris Otto ran PSG Holdings. At one point, they had read a book about Grameen Bank in Bangladesh, which provided microloans to poor rural people without requiring any collateral. Most borrowers used the money to fund small businesses, and over time, the bank helped lift many people out of poverty through microlending. The model was so impactful, its founder, Mohamed Yunus, was awarded a Nobel Peace Prize. Now, inspired by this story, Yanni and Chris developed their own vision. In 1998, they launched a division within PSG focused on microlending and alternative banking, which they called PSG Specialized Lending. They recognized that South Africa had a major challenge with millions of unbanked, low-income individuals. This division began aggressively acquiring payday and 30-day loan shops across the country, especially in rural areas. Now, these acquisitions gave PSG not only a wide footprint, but also access to valuable data and deeper insights into borrowers' profiles. They saw that if done right, this venture could both help people and become a highly profitable business. Now, to bring this vision to life, they needed a top-tier operator, someone experienced, strategic, and trusted. Now, since PSG was founded by individuals who had been mentored by Rupert, the Stellenbosch Mafia basically, they turned to one of their own, Michael Leroux, who had recently left Boland Bank. Now, this time, Leroux came with solid experience in banking. When Leroux joined PSG, he immediately saw the potential and insisted on bringing in his entire management team from Boland Bank. Now, with Boland having been shut down recently, the team didn't need much convincing. When Leroux called, they all showed up. Everyone sat down to map out this new project. They already had a large database and customer profiles from the loan shops they had been acquiring. They had visited many townships and rural branches to better understand the communities they were going to serve. What they discovered was clear. The emerging black market required a fundamentally different banking approach than what traditional banks were offering. Many customers were uneducated and didn't understand interest rates, so financial education was necessary. The process needed to be simple, paperless, and easy to follow. Some clients lived in informal housing like shacks and couldn't provide proof of address. So the team needed to come up with new processes like adapting fingerprint recognition technology to overcome those type of problems. They also learned that location mattered. Branches needed to be close to transport hubs so clients could access them easily. One of the most important principles the former Boland Bank team brought with them was the thinking like a retailer. Coming from the world of Pep and ShopRite, Christo had always emphasized this approach. Serving poor working class customers required a different mindset than serving the middle class. For example, they realized that blue-collar workers finished work late, so banking hours needed to be extended to at least 5 o'clock. That came from Boland. They also noticed that customers would spend an entire day walking shop to shop, paying off debts at month end. So they developed a technology to consolidate those payments, allowing clients to pay all their debts at once with the help of a teller or a consultant. The team went all in to understand the emerging black market as best as they could. All that remained was to clean up the image of microlending, often associated with loan sharks, lower their interest rates, and secure a full banking license. While the rest of the PSG team was focused on acquiring more cash loan shops to consolidate into a single company, the former Boland Bank team was quietly building a real bank. They met daily, sharing ideas, refining strategies. They engaged directly with customers in remote and rural areas, listening carefully to their needs to truly understand how to serve them better. For 8 months straight, the team worked day in, day out, refining this business model. Their goal wasn't just to create a bank for the poor. It was to build an innovative bank with a crossover appeal that could eventually serve all segments of society. The products would be simple, effective, and stripped off unnecessary extras, much like Pep stores, which had already mastered the low-income retail market. To reduce paperwork and simplify the process, technology had to be the driver. They brought in the same IT expert from Boland Bank, who had previously computerized operations that side. Now, to move quickly, Chris Otto, the IT guy, suggested that they purchase an existing banking software system from Australia, which they could customize for the South African market. Now, when it came to getting a banking license, they discovered that PSG had already had one. They had purchased it earlier from a finance institution that went bankrupt in anticipation of starting a bank someday later. Their branch model was simple but innovative. Small physical spaces to keep rental costs low with no administrative staff. Consultants would be trained to handle all customer needs directly without needing on-site back office support. And all admin tasks would be handled through a centralized support function and a data-driven call center. Now, this lean structure would help reduce costs so customers wouldn't be overcharged for basic services. Only now the big banks are doing this. Now, the big banks now are downsizing their spaces and digitizing their bank processes to reduce costs. But Capitec has long been on that wave. By the year 2000, PSG had acquired a lot of micro-lending shops, close to 400, and the team was ready. At this point, smaller lenders had little choice but to sell. Capitec was going to offer the same loans to the same customers, but at a much lower interest rate, eventually running them out of business. Most people had no idea what was happening or who was behind this mass acquisition. Now, the infrastructure was quietly laid down. And then came the strike. In 2001, Capitec launched its first 2 branches in Bellville, Cape Town. Soon after came Durban, then Port Elizabeth, then Vereeniging and King Williamstown. These were the testing phases, the early days. Now, at first, the business world didn't take them seriously. The industry still viewed them as glorified loan sharks, not real bankers. But first thing they did was to slash the interest rates, first to 20%, but it didn't bring them any more customers. So they realized that the customers didn't understand interest rates, so they had to educate them. They slashed the interest rate again to 17%, then 15%. Then word quickly spread that Capitec was offering 30-day payday loans at half the cost of competitors. Even better, they offered a 3-month repayment option, which appealed to a lot of people. Once customers started experiencing the simplicity and affordability of Capitec's services, adoption grew rapidly. Then came the game changer. Capitec was very helpful to old and illiterate people who were never experienced in banking. They made it easy to understand and affordable compared to the intimidating big banks charging service fee just for breathing inside their branches. Now later, Capitec would give you a 10% interest annually for keeping your cash in the savings account. At this point, the big banks finally started to take notes. They responded by launching the Mzansi accounts aimed at low-income market. While it gained traction briefly, Capitec remained the superior option. Unlike traditional banks, Capitec's team knew how to price their products properly and meet customers where they were. Traditional banks, on the other hand, had made billions of unjustifiable service fees, such as fees for bounce transactions, which cost the bank nothing, but were still charged at a high rate. Now, Capitec avoided these exploitative practices. Their products were better, pricing smarter, and their focus on real customer needs set them apart. During this period, PSG was facing a crisis. Its share price was falling due to the association of PSG Investment Bank with micro-lenders, many of which were in the process of being slowly converted into Capitec branches. It took time for Capitec to shed the image of being a loan shark operation and establish itself as a legitimate bank. Still, the leadership of PSG believed that Capitec was ready to operate independently. It had the right people in place, a clear strategy, and growing traction in the right market. At the time, Capitec's biggest competitors in the lending space were African Bank and Sambo Bank, both of which were targeting the same underserved niche market. However, due to poor management, both rivals eventually collapsed, while Capitec continued to grow. Once PSG decided to spin off Capitec, the team had to stand on their own. They needed serious funding to fully legitimize their operation, from converting storefronts to formal branches to integrating their technology systems. But no one wanted to back them, even though the business itself was performing very well. With no other option to raising capital, now Capitec listed on the Johannesburg Stock Exchange in 2002. They had hoped to launch the share price at 5 rands per share, but it opened at 3 rands and quickly dropped, at one point falling to 1 rand and eventually to just 80 cents per share. Things were looking bleak. In fact, the total value of the company shares was at one point less than the value of its actual assets. Still, the founding team didn't give up. The top 4 executives invested millions of their own money to keep the company afloat while they worked on securing outside funding. Despite their solid operation on the ground, nobody believed it was possible to build a successful bank in South Africa outside of the Big Four. The idea of an independent bank hustling its way to the top seemed impossible at the time. Eventually, they secured a breakthrough: USAID, United States Agency for International Development. They agreed to back them with a 50 million rands check. Basically, these guys explained to the Americans that they were helping poor communities by giving them microloans at a very little interest rate. And then in turn, these people were uplifting themselves out of poverty through this money, creating businesses, whatever the case may be. And the Americans were convinced and they gave them the check. Capitec used that funding as surety to raise additional capital. When they returned to the market, investors took notice. The USAID backing gave Capitec credibility. Now everyone wanted in, fearing they might miss out on a potential success story in the making. One of the smartest things Capitec did was to never use customers' deposits for investments, a common trap that leads to collapse in the event of a panic. Instead, they focused purely on lending until they had the right systems in place. Only in 2003 did Capitec start accepting deposits. They built their foundation carefully, unlike pyramid schemes or unstable lenders that collapse the moment too much customers try to withdraw their funds. With funding in place, Capitec went all in on expansion, especially in rural areas and townships. The leadership team hit the ground themselves, scouting locations near taxi ranks, pep stores, ShopRite outlets, anywhere close to their target customers. The old micro-lending shops were being converted into full-service banks. Now in the mid-2000s, Capitec branches began popping up everywhere. They even struck a deal with supermarkets to allow their customers to withdraw cash at their tills, which helped solve the problem of limited ATMs available at that time. Now that strategy was such a success that soon other banks followed in that same strategy. By 2007, Capitec had reached 1 million customers. Then in 2009, they opened their first branch in a shopping mall, something that would have been unthinkable just a few years earlier when mall owners still saw them as weird loan sharks. Amazingly, Capitec accomplished all of this without any major advertising. The bank grew entirely through word of mouth because the services were necessary, affordable, and reliable. Capitec wasn't just offering banking, it was offering hope and a sense of dignity to customers the traditional banks had ignored for decades. The bank now has close to 13 million customers. It has more customers than the big banks. Its relentless focus on cost efficiency has paid off handsomely. The bank has consistently delivered double-digit growth year after year for over 15 years, far outpacing its competitors. Today, Capitec stock is trading at 1.4 to 1.5 thousand rands, representing a staggering increase from its early days. It's widely regarded as a perfect case study on how to grow a successful bank from the ground up. Now, as Capitec evolves, it is gradually shifting from its unsecured lending roots towards a more traditional banking model, including expansion into small business lending. They want to capture a larger share of the formal banking sector, challenging established rivals in new segments. However, Capitec is no longer the scrappy underdog. It now faces growing competition from digital-first, tech-savvy banking startups, many of which have drawn aspiration from Capitec's own success and now aim to replace it or surpass it. This story goes beyond what's shown in the video. It's my own summary of the Capitec's journey. I've intentionally left out many of the finer details, especially those involving the numbers and various measures between the micro lenders, as including all of them would have made this video far more complex, way longer and harder to follow. You see, my goal was to highlight the most important points while keeping it clear, digestible and easy to understand. But anyway, hope you guys enjoyed the video. Thanks for watching.